What's up, everyone? 1 second here. Having a little bit of a glitch on the stream. 1 second. All right, looks like it's working here. Welcome, everyone, to today's daily macro update for Thursday, December 11th. We had a little bit of a jumpy morning as we had the Oracle earning announcement yesterday after hours, showing a pretty large loss. And this really bit into the whole AI bubble narrative, right? So how sustainable is this AI bubble? Is it mostly just investment? Is there really a lot of value being created right now with all of this investment going into AI, right? And that's really the big question here. And unfortunately, we are in this type of narrative driven environment in terms of AI, as well as the amount of growth that's being projected out for next year. And so, that's something that's going to continue to spook the markets if we keep getting these AI names starting to, not produce. And so that is a risk heading into 2026. But we can talk a little bit more about that on the charts here, which we had a pretty decent recovery so far. So, they're really just provided a decent buying opportunity. We do have Broadcom earnings after hours, which, the market closes in about 10 minutes here. So we'll see what happens from there. But what I wanted to do was just go over a few of the headlines as well as just recap the FOMC from yesterday, just to give you the key takeaways. And so we can go over some of the different headlines that I was seeing yesterday. The first one being, the big growth projection that they had on their summary of economic projections report from yesterday. They're saying that there's going to be a huge acceleration in growth next year. And this is mainly driven by AI. And so that is pretty interesting, especially seeing how we're starting to see a little bit of a downtrend with the fiscal deficit spending. And if you guys haven't been watching the channel for that long, maybe you have, but one of the key main drivers of this market has been the fiscal side of the equation, right? So a lot of the fiscal deficits, a lot of the front running of treasury securities in bills in terms of treasury issuance. The government has been essentially funding its deficits through bills mainly. And, that's something that is a temporary fix. That's not something that can be done permanently. And so what's interesting is that the summary of economic projections report is a complete 180 contrast compared to the October Fed meeting, which was only 6 weeks ago, right? If you remember during that meeting, that was a little bit of a hawkish cut where they were a little bit fearful in terms of where the labor market is headed, which, they've been saying now that it might be stabilized, as well as inflation fears. Now it was almost like a complete flop where Powell went on the stand and said, hey, GDP for next year looks incredible. We actually aren't in any type of recessionary fear land. We're in the exact opposite. And also, too, when it comes to inflation, on the progress on things that actually matter, we've been doing well on. The reason why inflation is still high is all because of tariffs, 100% because of tariffs, which there's some truth to that, right? These politicians do a very good job with telling you somewhat of the truth, right? There's truth hidden in what they say, but it's not in the correct context typically. And so with inflation, with goods inflation still remaining higher, we're still seeing services inflation as well as housing inflation remain well above the pre-pandemic target, which we'll get into here in a second. But taking a look at some of the comments here, Powell was saying that tariffs are the only thing that's causing inflation to overshoot right now. And once the tariff situation is solved, then we'll get back down to 2%. Yeah, so inflation for goods is up because of tariffs. Services show continued disinflation, which is not false, but you could have said back in 2022, going from 9% inflation down to 6% inflation, That is continued disinflation, but it's still not great. That's kind of what is being shown here with services as well as housing inflation. Yes, they are showing some disinflation, which we should get more numbers, more updated numbers next week once we get the CPI report, which we haven't gotten in 2 months. But we are seeing progress on that, but it's still way higher, right? And when it comes to the inflation component, what matters the most for people like you and I, yes, goods inflation is important, but really, what are the biggest expenses for us? It's shelter and services. Those are the big ones, right? And out of the services component, healthcare is the biggest service component for the United States, and that continues to remain well above the 2% target. So, he's framing this in a way to make it seem like they're perfect and that all of the inflation issues that you're experiencing is pointing at Trump. Yeah, I mean, when it comes to inflation, it's really that Spider-Man meme between Trump and Powell, where it's like the two Spider-Man like pointing at each other, when really they're both causing it at the same time. They both do a pretty good job with gaslighting the public there. And so the forward guidance for this goods inflation by Powell, he was saying that goods inflation from the tariffs should peak in the first quarter of next year. So between January and March of 2026, inflation should peak in terms of goods inflation by tariffs, as long with, and this is with an asterisk, as long as new tariffs aren't introduced. And then after that, we should be seeing a more broad disinflation in the headline number. So expect this headline 3% inflation number from now until March, right? And then that's up until those months. And so in order for us to receive any type of disinflationary type of numbers for April, that would be reported in the month of May. So he's essentially saying here, don't expect inflation numbers to be coming down and headlines showing that until May of next year. So yeah, that still doesn't solve the problem for the American people, does it? And then in terms of the whole tariff effect, another 9 months from here. So that's what he was basically saying, but they have no fears about inflation at this point. In fact, the only reason why they would stop cutting rates is because they're saying that growth is going to get too crazy next year. So that's pretty interesting. That's a full 180 flip. That's not even a soft landing. That's like a home run, Now, this is where a lot of people got tripped up when it comes to the reserve balances and the purchases of treasury bills, because a lot of people are viewing this as full-blown quantitative easing, right? Thinking about, 2020, the 2008 Great Financial Crisis. Now, this is technically a form of quantitative easing, if you'd like to say that, only because they are starting to have a net positive addition to their balance sheet, but it's not the same, right? And I'll do a way bigger deep dive maybe on Sunday's Sunday Macro wrap up on this. But when you take a look at a chart between the demand curve between reserves as well, available reserves, between the discount rate and the interest on reserve balances, there's a big chart, slide chart there, and I'll go over it on Sunday in more detail. But a lot of people were thinking, this QE that they're doing now, it's just like how it was before, and all the Bitcoin bros are getting super excited. Which, I mean, this is kind of like a first step towards that, and eventually it will go back to that. But here's the difference, all right? So we were just in a position post-pandemic at a point where we had what's called abundant reserves. So this is when reserves in the financial system were so high that liquidity was just what's called abundant, right? Bitcoin loved that environment. It went to 126K. Now that they're in an environment where reserve balances have come down to what's called an ample level, they don't want it to continue going down further into a what's called scarce level, which is really when you get into hot water with the financial markets. If you get too scarce reserves, that's when things are breaking, right? So you can think of this as like, water draining in a bathtub. They were full. Now they're at the just right level and they want to hold it there. And in order to do that, they're doing this QE light where they're essentially letting a lot of things that are long duration bonds, as well as their mortgage-backed securities, which they've already said that they want to get rid of. They're letting those things roll over and then taking those principal payments and loading those up into treasury bills. And so they are making purchases of treasury securities, but they're bills, not long duration bonds like they did back during full-blown QE. And yeah, so this is not only maintaining ample reserves, but also too, it's providing some demand from what the government continues to do, which is to fund the deficits with treasury bills. And this is probably going to make up for the decline in some of the foreign demand for treasury securities. In other words, they're continuing this Band-Aid, and they're going to successfully continue to give the appearance that things are great, even though they're still just trying to buy time with this, right? So again, it is technically adding reserves to the system, but it's not QE. It's like baby tiny QE, and it's just to maintain these ample levels. It's not full-blown QE where things are at a scarce level and they're trying to bring them back up to abundant. Does that make sense? It's like if you're trying to lose weight and you get down to your goal of whatever weight you're trying to achieve, you're not trying to go even lower than that and get too skinny, right? You're just trying to stay exactly right there. Okay. Whereas before, what people think about is like, oh my gosh, I'm starving. I'm literally about to die because I don't have any food and I need to shove my face with hamburgers right now. That's full-blown QE. That's not happening though. Okay. And again, I'll do a little bit more of a deeper dive on Sunday on this to show a little bit more of the charts on that. But, I just wanted to clarify that there. And then Powell went ahead and sort of guided to next year, saying that, we are pretty much well positioned to just wait and see what happens from here, and that they're in no real hurry to start to cut rates from here, and that they're closer to those or they're closer to their neutral rate, which that's a made up number. So that's what he was suggesting there. Now, this article by Mace News, I did like to go into a little bit of the details here from their writings, because I thought this article was pretty great. So let's just go over some of the highlights here. So including the 100 basis points of cuts implemented in the fourth quarter of 2024, the FOMC has now eased by a total of 175 basis points. Yet the incremental reduction still leaves the funds rate 60 basis points above the unrevised 3% longer run neutral rate. So the Fed is probably not done, certainly not if President Trump has his way, right? So President wants to bring in a potential new candidate. His name is Kevin Hassett, to take over for Jerome Powell. He's more of a dove, and so that's what they're trying to do there. But before the FOMC gets back to moving their funds rate further towards neutral, there may well be a pause, at least until mid-March, based on what Powell said at the press conference. Powell repeatedly told reporters that the Fed is now well positioned to wait and see how the economy evolves before considering additional cuts. And he said that the Fed is now within the upper range of the estimates of the Fed estimates of funds rate neutrality. So now that they're within the ballpark of their quote-unquote made-up neutral rate, I think they just want to wait and see what happens from here, which is interesting because, if you go to the target rate probabilities, looking at the Fed Watch tool, let me just go ahead and do a refresh on this. It said yesterday, so it's still above a 75% chance that they're not going to cut in the January 28th meeting. But when taking a look at the SOFR watch, we can see what months that they're planning on cutting. Once in April and then another one in September. So we'll see. It used to be 3 cuts that were being priced in for the month of, or for the year of 2026. Now it's just 2. So a lot of people are characterizing yesterday's Fed meeting as a hawkish cut, which I don't think it's quite that, but that's what we're seeing there. And then when it comes to the dissents, there was a rare 3 dissents during this meeting, which I didn't hear too many people talk about. And so 3 of them, 3 out of the 12, which is pretty rare, actually said that they preferred to keep rates steady from where they're at. So that was pretty interesting there. And so that was really all that I saw in this article. But yeah, so that's essentially what we saw from yesterday's Fed meeting. And so if you guys want to watch the entire stream, we did stream it live and do a market reaction with some live analysis there. So just go to the lives on our YouTube, the live streams on our YouTube page, and you can just watch the stream from yesterday at double speed if you guys would like to do that. But yeah, taking a look at the charts for today. Let me just bring this up here, zoom out a little bit for you. Well, what's interesting is the things that have been going up a lot, which are more of like, some of the more inflationary types of assets, right? So the big things were, metals and mining ETFs. You also have silver junior miners, which the ticker SLIJ is the one that my team and I likes to utilize, as well as SIL. Both of these, I mean, silver and silver miners have been the best winners over the past, couple weeks. Since May, silver has been outperforming gold. So I know a lot of people ask, should I buy gold or silver? I mean, right now, silver has been winning, right? If we take a look at this ratio here. But if we do get a spike in gold and this ratio starts to reverse, then we'd probably move into a period where we'd be more heavier on gold, right? Even though both are in a bullish trend. It's still good to own gold, don't get me wrong, but silver has been the clear winner, right? So that's really what we are seeing there. And then some of the bigger losers for today, still the cryptocurrency market, which should be, based on what the Fed's comments were yesterday, should be doing pretty well, yet it still remains a little bit muted, Still though, we are seeing an uptrend bounce here pretty much since the end of November. What's interesting is that we didn't quite get a higher high on an immediate term basis from Bitcoin. So, we want to be paying attention to that. And again, when I say paying attention, it's still in bearish trend. So I'm not buying this yet. I still want to wait for it to confirm its bullish trend and then buy on the next low volume dip. For now, it's still a wait and watch, but seeing this bearish divergence here, it makes me hesitant, as well as, in taking a look at when taking a look at net central bank liquidity, we haven't really seen a large jump up in that as well. So, yeah, I do think that there's something going on here still on the liquidity front, because typically Bitcoin does well when either growth or inflation or both at the same time are accelerating. And so, yeah, right now I'm just using Bitcoin as like a big macro signal, because again, it's also very liquidity sensitive. And yeah, I'm just not seeing the strength there. What's a little bit more interesting and is showing a little bit more strength in terms of this bounce is actually Ethereum. So recently, Ethereum did make a higher high right here, and that has a little bit sharper of a trend. And so if we take a look at, do I have that ratio up right now? We can just create it real quick. Let's take a look at Ethereum versus Bitcoin real quick. Yeah, so as you can see, this recent move here, so this is Ethereum priced in terms of Bitcoin. It's had a pretty interesting pop here. And so I would probably want to see some more progress on this, but yeah, it's looking like ETH is gaining a little bit more strength to Bitcoin. I'm curious to look at some of the on-chain data as well as the ETF flows on that. But that's what I'm seeing on that front there. Semiconductors continue to struggle, especially with names like NVIDIA. Um, NVIDIA, it's no longer bullish trend, so that went back down to neutral. So yeah, NVIDIA and semiconductors, not doing the hottest right now, which is pretty interesting. Now we do have Broadcom earnings, which had a little bit of a dip today, so that was kind of a buying signal here. But that's the big earnings announcement that we're about to see here, probably in the next 30 to 45 minutes. The ticker for that is AVGO. And so what our team did do well was the bearish call on the dollar. If you guys remember, about 6 or 7 days ago, um, we had the dollar go bearish trend on December 3rd, and then it gave us a little bit of a chance to get rid of it before it went down further. And so, when taking a look at the immediate term correlation matrix, let me see if I can find it here. Oh, that's with gold. Frickin' MacBook. All right. All right. Well, all right. Here we go. Positive correlation between Bitcoin and the dollar. So that's actually kind of interesting. A large acceleration signal that a 15-day rolling correlation. Testing, testing. I think we're back. Yeah, so we can get into some questions here. What do you think about physical gold versus ETF gold? I think you should own both. Appreciate all the likes and shares. Thank you. Is crypto is global asset right now? How QE and QT of US affect global assets? Well, I mean, the Federal Reserve's pretty much when they're setting interest rates, those are the world interest rates. So yeah, it has a huge effect on global central banks. All right, if you're going to be, hold on 1 second. I had one person spamming the chat. I had to block them. All right. Well, kind of an anticlimactic way to end the stream here with the freezing and the glitching, but yeah, I think we got through most of it at the beginning there. But yeah, I mean, at the end of the day, volatility remains incredibly low. I mean, the VIX just closed below 15. I mean, it doesn't get much bullish than that. Gold is higher, silver's higher. S&P 500, new all-time highs. Man. It looks like Broadcom just reported. Yeah. But yeah, that's pretty much all I have for you guys here today. We're going to be back here on Sunday for the Sunday macro wrap-up, which is every single Sunday at 8 p.m. And so we'll be doing a nice little follow through there. Now, if you guys want to incorporate a lot of this macro data into your everyday investing process, going through our community, we still have more available spots for the 6-week challenge. That's when you get access to our partnership circle, what assets that we're long, given the macro environment, which ones are bullish, which ones are bearish, different alerts, our entire process, video modules on how you can implement for timing and all those things. And as well as just being in a live chat with myself and the team in case you need any, thoughts throughout the day. And so if you guys are interested in that, just go to the link in the description, book a time on my calendar, and we can review everything on the call there. But I appreciate everyone for joining. Have a great rest of your Thursday. No show tomorrow, but we will be back on Sunday for the Sunday macro wrap up. Everyone have a great rest of your weekend there. Bye, everyone.